In life, we often make decisions based on our past experiences, whether it's choosing where to dine or deciding on hiring a candidate for a job. We tend to look to the past for guidance. Past experiences shape our choices for the present and the future. But when it comes to investing, does this principle hold true? If a mutual fund performed exceptionally well in the past, does it guarantee future success? Can we solely rely on good past performance to predict future success? Let's understand this. Imagine you must invest in equity mutual funds today. The logical step seems to be selecting the top performing funds. You might sort funds by their highest 3-year returns and identify the current top 5 diversified equity funds with the best 3-year returns. It seems straightforward, doesn't it? Here's where it gets intriguing. To get the highest returns from these top 5 funds, you'd have needed to invest in them 3 years ago. What do you think the ranking of these top 5 funds was back then? Prepare for a surprise. The top 5 funds from 2020 to 2022, based on their 3-year returns, were on average ranked 130 out of 168 funds from 2017 to 2019. Given this information, would you have selected these funds in the past? Especially when they weren't even among the top 30? Perhaps not. Conversely, if you had chosen top performing funds from the past, you'd expect them to remain at the top. Let's see how they fare now. If you had invested in the top 5 funds from 2017 to 2019, they are currently on average ranked 115 out of 200 funds. This inconsistency can be baffling. Today's top performers were not necessarily top performers in the past, and vice versa. Did something unusual occur in this last 3 years? Actually, this isn't unusual. Let's take a look at fund rankings from the past 20 years. As history shows, relying solely on past performance isn't a sound approach. But why does this happen? Equity funds go through cycles, with various investment styles, market cap segments, sectors, and geographics excelling at different times. This is why selecting funds based only on returns doesn't work over a long term. So what should you do? While past performance matters, it shouldn't be the sole factor. Ideally, you should consider a mix of quantitative and qualitative factors like performance consistency, investment philosophy, risk management, and an experienced fund manager. To sum it up, past performance is not enough to predict future performance. Avoid chasing performance. A better approach is to select funds using a combination of factors and diversify across different styles, market caps, sectors, and geographies. That's all for today. Hope today's video was insightful for you. Let us know by leaving a like or sharing with your friends. Happy investing!